Here at the New York Stock Exchange, an abundance of financial instruments are traded. The major equity averages are frequently mentioned, and those indexes include the Dow Jones Industrial Average as well as the S&P 500. Joining me today is Michael Keating of InnerHarbor Advisors. Mike, thanks for joining me today.
Thank you, Remy.
Well, today we'll take a closer look at the Dow Industrials and the S&P 500. Recently, those two indexes have been in the news given their record highs.
Yep.
But let's start out by taking a closer look at the Dow Index. What exactly is it, and what is it made up of?
Right, so since we're in a place where equities are traded, I thought it would be a great idea to talk about the indexes. The Dow and the New York Stock Exchange being somewhat synonymous with the Dow. The Dow is actually 30 companies, so it's comprised of, it's an index that takes the price of 30 companies and averages them out. So in the very beginning, when the Dow Industrial Average was first configured, it took the 30 companies and divided by 30, way back when. Today, that divisor, instead of being divided by 30, is something like 0.13, and that's because over time there's been some dividends and some other capital restructures to make sure that the Dow is more reflective of what the price is. So it's in the case of the Dow, it's 30 companies.
And now that we've covered the Dow, I do want to move on to the S&P 500. And can you tell me the difference between the Dow and S&P 500 when it comes to how they're weighted?
Sure. So the S&P 500 is 500 companies and the Dow is 30, so that's the glaring difference. But it's how they're weighted, how they're calculated. The S&P 500 is the capitalization of the company, so the value overall of each one of those 500 companies is taken into account. Whereas with the Dow, it's the share price that's taken into account only. Now the share price is a component of the capitalization of the company, but it's only one component. That's why a lot of industry experts will prefer to use the S&P as the index of choice.
And Mike, now that we've discussed what the indexes are made up of, what about the dividend, and how are those indexes related in terms of a relationship?
Sure, that's a great point, especially now. And in our research, we came up with basically from 2007 to today, or early 2013, these indexes are returning to their historical highs. But when adjusted for dividends, and most of the index don't account for the reinvesting of dividends. Whereas if you had reinvested those dividends along the way, the indexes are actually somewhere around 12% higher today than they were in 2007.
And Mike, last but not least, before we wrap it up, we talked about the difference of the nominal high for the Dow and what it means when it's adjusted for inflation. Right. But what other tips should viewers out there in the audience keep in mind? Well,
that's a great point to bring up the Dow. The Dow takes into account 30 companies, and it's by price. So the most expensive company by price in the Dow today is IBM, right around $215 a share. Alcoa is the cheapest at around $8.50 a share. So quick math says the price movements in IBM have a 25 times greater impact on the overall Dow index than Alcoa does.
Well, that is very important to keep in mind, especially when earnings season starts rolling around again. So thank you so much for joining me, and thanks for a better understanding of the indexes.
You're welcome. Thank you, Remy.